Welcome to the Explainer. Today, we're mapping out the literal math behind the dividend snowball. Look, if you've ever felt like your investments are just kind of crawling along, you are absolutely not alone. So let's unpack these numbers together and see why patience isn't just a virtue here, it's an absolute mathematical necessity if you want to actually reach that dream of $5,000 a month in passive income.
Which brings us right to our core question. How small can you start and still get this dividend snowball rolling? You know, nobody wants to hear just be patient when the account balance is barely moving. That initial frustration is incredibly valid. But today, we're going to push through that and reveal the exact mathematical blueprint to a $1.5 million portfolio.
So here's our roadmap for this explainer. First, the slow start of compounding. Second, the $100,000 tipping point. Third, yield versus dividend growth. Fourth, building the dividend portfolio. And finally, two very distinct paths to our goal.
All right, part one, the slow start of compounding. Let's just validate something real quick. The early investing grind, it is painfully slow. I mean, imagine you have $10,000 invested at a 5% dividend yield. Your first year pays your $500. You logically reinvest it, and those new shares also yield 5%. Do you know what that entire year of reinvesting actually bought you? A grand total of $25 a year, literally $2 a month. You don't feel that, it doesn't change your lifestyle, and it's exactly why so many people just quit right at the starting line. But as you'll see, the system isn't broken, it just lacks weight behind it.
Which takes us to part two, the $100,000 tipping point, and when momentum finally takes over.
Now, when you look at the sheer shape of the math, something genuinely wild happens. If you start with $100,000 and just let it grow at 8% a year, the first decade adds about $115,000. Decent, right? The second decade adds $250,000, but look at the third decade. It adds over $540,000. That third decade produces more growth than the first 20 years combined. It proves a vital rule. Compounding runs on size way more than it runs on time. Time just multiplies the size you already have.
And that right there brings us to some legendary advice. Charlie Munger once famously said, "Get your hands on $100,000 however you can." He described investing like rolling a snowball down a really long hill. It's incredibly slow at the top, but near the bottom, you couldn't stop it if you tried. He put a specific dollar amount on that threshold because that is exactly where the snowball gets too heavy to stop.
So, the crucial concept here is what we call the handoff. Think of it as the ultimate mathematical threshold where the portfolio's momentum takes over most of the heavy lifting. Below $100,000, you're the engine. Every dollar of progress is basically a dollar you had to push up the hill yourself. But above it, the account takes over the pushing. The new income buys shares, which produce their own serious income.
Moving on to part three, yield versus dividend growth, or the mechanics of the engine.
You see, when people are picking stocks, they often look at the complete wrong thing. Dividend yield is what a stock pays you right this second. Dividend growth is what it's going to be paying when it actually matters later. Yield feels fantastic immediately, right? The cash just shows up. But if that payment barely moves over 20 years, inflation is going to slowly eat it alive. Dividend growth runs on a totally different clock. It hands you a bit less today, but it commits to giving you a raise every single year. Yield helps you start for sure, but growth decides how far you ultimately go.
All right, part four, building the dividend portfolio with actionable tools. To build this compounding engine, our source for this explainer, John, uses three intentionally boring but absolutely essential rules. First, a long history of paying and raising dividends. Second, a payout ratio under 70%, which basically ensures there's room to keep raising those payouts from growing earnings. And third, low turnover, so he isn't tempted to make bad decisions during rough years. It's a super strict filter meant to weed out weak businesses.
So, what actually survives that rigorous filter? Well, we have 5 core holdings here. SCHD, which is basically your anchor index fund covering 100 solid dividend payers. ABV, a company that kept raising dividends even when they lost major patents. LO, or Lowe's, consistently raising payouts right through terrible housing markets. AGM, Federal Agricultural Mortgage, quietly dominating farmland loans with over 22% dividend growth. And UNH, United Health, which just kept raising its dividends straight through its roughest stretches. Now run all 5 of these together in an equal weight, and you get a 2.7% yield today, but a massive 14.96% dividend growth rate. That double-digit growth rate is exactly the secret sauce that turns a tiny start into serious, life-changing wealth.
Finally, part five, 2 paths to reaching that $1.5 million goal.
Getting there really comes down to a choice based on where you're at right now. Path 1 is a $15,000 lump sum. This is for you if you've got some savings parked somewhere doing nothing. Path 2 is $7 a day, or roughly $2,555 a year, starting from literal zero. This is the path of extreme, consistent daily habits if you don't happen to have a lump sum lying around. Let's see how they perform.
Looking at the lump sum path, John puts in his 15 grand and literally never adds another dime. Fast forward to year 22. In that single year, the portfolio is projected to pay him $14,866 just in dividends alone. Just think about that for a second. A single year of passive dividends essentially reimburses the entire original out-of-pocket cost. 1 year later, the annual dividends completely exceed his starting capital.
But what if you started from zero and took the $7 a day path? Check out this fascinating crossover moment. In year 13, the portfolio pays $2,756 in dividends. Why is that a big deal? Because your annual deposit is only $2,555. This is the exact year your portfolio officially starts paying you more money than you are putting in. The gap just widens beautifully from there, eventually hitting that $5,000 a month goal by year 30.
But wait, we have to talk about the total cost. The lump sum path required exactly 15 grand out of pocket, but the daily path, that requires $76,650 of your own hard-earned money over those 30 years to reach the exact same monthly income. It proves a universal truth of investing. Time is the cheaper input. If you have it, you need less cash. But if you don't have the cash up front, you have got to make it up with relentless consistency over time.
So, this leaves us with one incredibly important question to ask yourself today. Time or consistency? Which path is going to build your snowball? Are you going to deploy a lump sum today and let time do the heavy lifting? Or will you commit to the daily grind and build it dollar by dollar? Honestly, evaluate your starting position right now, because the only real wrong move here is not